All right, let's talk about stocks. It's one of those topics that's everywhere but can feel super confusing, right? Well, today we're going to cut through all that noise. We're going to break down what stocks are, how they work, and why they even exist in the first place, all in a way that actually makes sense. So let's get into it. You know the feeling. You're just scrolling your feed, and bam, it's all charts, weird acronyms, and people yelling about buying the dip or going to the moon. It honestly feels like a secret club speaking a different language. But here's the thing, the big idea behind all of it, it's way simpler than it looks. So let's start with the absolute basics. What even is a stock? Put simply, it's a tiny, tiny piece of ownership in a business. When you buy a stock or a share, you're not just buying some random ticker symbol on a screen. You're literally buying a small slice of that company. And just like owning a slice of cake means you own part of that cake, owning a share means you have a claim to that company's value. Okay, that brings up a really good question. Why on earth would a company want to sell off little pieces of itself to total strangers? Well, the number one reason is to raise money. And to make this super clear, let's ditch the boring theory and tell a story instead. So let's meet Maya. She has this amazing dream to open her own sneaker store, Fresh Kicks. She's figured out she needs $100,000 to make it happen. But here's the problem. She only has $50,000 saved up. So what does she do? She gets creative. She decides her business is worth $100,000, divides it into 10 equal shares, and puts 5 of them up for sale. In walks Jordan. He's a total sneakerhead. He loves Maya's idea, and he wants in. So he invests $10,000 to buy just one of those shares. And just like that, Maya gets the money she needs to open her store, and Jordan becomes a 10% owner in the business. And the best part? No bank loans, no debt. So Jordan's officially a part owner of Fresh Kicks. Awesome. But now what? This is where we get to the real heart of investing. The part where you can have these huge wins, but also some pretty tough losses. Let's see how this could actually play out for him. Okay, let's hit the fast forward button and jump 5 years into the future. We've got 2 possible paths for Fresh Kicks. In scenario A, the store is a smash hit. The business is now worth triple what it was. But in scenario B, things didn't go so well. Maybe online competition was tough and the value of the business actually dropped. Jordan's initial investment is completely tied to which one of these futures becomes reality. First, let's look at the best case scenario. The business is a huge success and is now valued at $300,000. Well, Jordan still owns his 10% stake, right? But now his 10% is worth $30,000. He turned his original 10 grand into 30. That's a $20,000 profit just from believing in a good business. That's the reward everyone's hoping for. But we have to look at the other side of the coin. What if the store struggles? If the business value drops to $80,000, his 10% share is now only worth $8,000. He's lost $2,000 of his initial investment. This is the risk, and it is so important to remember that things can and often do go down as well as up. So you might be wondering, is the only way to make money when the stock price goes up? Nope, not at all. Some companies, usually the bigger, more stable ones, decide to share their actual profits directly with their owners. These payments are called dividends. You can kind of think of it like a cash bonus or a thank you check, just for being a part owner. Okay, check out this table. It really shows 2 completely different ways to invest. On the left, you've got a stock that's all about growth. That's our successful Fresh Kick story, where all the money came from the share price skyrocketing. But on the right, you have a stock that's focused on paying out income. You can see its value didn't grow nearly as much, but it paid out a nice, steady stream of cash in dividends over the years. This gave the investor a smaller, but maybe more predictable return. 2 different strategies for 2 different goals. So, we get what stocks are and why companies sell them, but where do you actually buy them? I mean, you can't just walk into Apple's headquarters and say, "I'll take 1 share, please." For that, you need to go to a very specific kind of marketplace. And that marketplace is called the stock exchange. The best way to picture it is like a giant worldwide digital farmer's market. But instead of people trading fruits and vegetables, they're buying and selling tiny pieces of huge companies like Tesla, Amazon, and thousands of others. You've probably heard of the big ones like the New York Stock Exchange or the NASDAQ. And the craziest part is today, you can get access to this whole world right from an app on your phone. So how does a company like Fresh Kicks get listed on a big exchange? Well, let's imagine the business is so successful it grows from one little shop into a huge national chain. To get the cash for that kind of massive expansion, Maya might decide to go public. And all that means is listing fresh kicks on a stock exchange so that anybody, you, me, anyone, can buy a piece of the company she started. Now here's where it gets interesting. Once a company is public, you'll find that not all its stocks are exactly the same. They usually come in two main flavors, and each one comes with its own set of rules and perks. Let's break those down. A really easy way to think about this is like you're buying tickets to a concert. Common stock? That's your regular general admission ticket. It gets you in the door, and it gives you a say in what songs the band plays. Preferred stock, on the other hand, is like the VIP pass. You might not get to vote on the set list, but you get some special treatment, like first dibs at the merch table. Let's get into the specifics. With common stock, you get voting rights in the company and the absolute highest potential for growth. But it's also riskier. Dividends aren't guaranteed, and if the company goes belly up, you're the last one in line to get paid. Now, preferred stockholders usually give up their voting rights, but in return, they get their dividend checks first, and they have a much safer spot in line if the company fails. So it's really a trade-off. Are you looking for maximum growth or more stability? Okay, we have covered a ton of ground. What stocks are, why they're a thing, where you buy them, the different types. But honestly, none of that is as important as the mindset you bring to the table, especially when you're just starting out. If you remember only one thing from this whole explainer, make it this. It is so easy to get caught up in the daily ups and downs of the price. But you have to remember, you're not just buying a flickering green or red line. You are buying actual ownership in a real business with real employees and real products. You're not gambling. You're becoming a partner in that company's future. So what does a smart, cautious approach look like? First, think in years, not in days or weeks. Second, and this is a big one, stick to what you actually understand. If you can't explain what a company does in a simple sentence, you probably shouldn't own it. Third, don't put all your eggs in one basket. Spread your money around. And finally, always remember that long-term investing is about betting on a company's success, while short-term trading is about guessing price movements. Those are two very, very different games. And that really just leaves us with one final thought. Take a look at the world around you. Think about the products you use every single day, the services you can't live without. Which of those businesses do you genuinely believe will still be around, and even bigger and better, 10 or 20 years from now? Answering that question for yourself, well, that's the true first step on any investor's journey.